President Biden said that depositors who have more than $250,000 in the Silicon Valley Bank, that amount, by the way, is above the FDIC guarantee, those depositors will not lose a single penny.
All customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will, this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. The management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
And what about the moral hazard of bailing out the depositors of that bank?
May God protect our troops. See you in California.
Mr. President, what do you know right now about why this happened? And can you assure Americans that there won't be a ripple effect?
Do you expect other banks to fail, Mr. President?
Alfredo Ortiz is the president and CEO of Job Creators Network. Alfredo, thanks for coming on. Alfredo, I've heard different things from experts, and these are not left-wing experts. I've heard on the one hand, he had no choice but to prevent a frightening situation where depositors all over the country were going to run on their own banks. I've also heard people say this is horrible, it creates moral hazard, it'll cause further irresponsibility and negligence down the road. What's your position?
Larry, well, thank you again for having me. So the moral hazard issue is definitely something that we want to talk about. This particular case that was Silicon Valley Bank, I really want to kind of break it down because this really, I think, was a very, very isolated case. There are other banks where there was kind of the mismatch between their, let's say, their securities and their investments and their balance sheets. So there are some issues there, and we saw already some of those banks go under. But Silicon Valley Bank was just a mismanaged bank, period. It pretty much acted more like an investment firm than it did anything else. And it really had a deposit base that wasn't a bunch of mom and pops. I mean, this is Etsy and all these other ones. These were large customers with large deposit base. And in fact, the uninsured percentage of deposits was 90% at that bank, where in the industry, it's actually the inverse. It's actually about only 10% is usually uninsured. So in this particular case, I think it triggered basically fear contagion amongst consumers, where there was effectively a run on SVB, which caused it really to collapse. I think the contagion had to be stopped to prevent the run on other banks. Now, my concern, though, is that there is obviously confusion between the president, between the Fed chair, and between Janet Yellen. Because at the same time that the Fed chair was talking about everything was going to be covered, Janet Yellen, in a testimony, was basically saying, well, not quite. We're really looking at only covering the tier one banks that would pose a systemic risk to the banking system and that are too large to fail. We've heard that before. Right. And the smaller regional banks that, well, they're not that important, and maybe we'll let them fail. Obviously, that has already triggered effectively a run on regional banks. $108 billion, Larry, of outflow from regional banks has already happened, an inflow of $120 billion to the Goldmans, to Citibanks, the Bank of Americas, et cetera. So my concern really is that, by announcing only a partial coverage, what Janet Yellen basically did is triggering a run on our regional banks unnecessarily. And that, Larry, is my biggest concern, because without regional banks, our communities, our small businesses, which are so dependent on our regional and community banks, they lose their lifeline of credit. And effectively, we start taking our small businesses and making them extinct by making our small banks and community banks, regional banks extinct in the way that they're currently doing it.
What's that? The great Aldersky, the sage from South Central, has in his baby brown libertarian fingers a pair of my slippers. Brought to you from MyPillow. As you can see, beautiful tan. They come in different colors. They also come in different styles. Here is the new MyPillow 2.0. Even better than the original MyPillow. So amazingly comfortable to sleep on. You'll wonder why you haven't gotten one yet. This is the MyPillow 6-pack of towels that work, meaning towels that actually absorb the water. Isn't that what you want towels to do? Have you noticed you go to the stores, they have these beautiful towels. They feel fluffy, they look great, some of them even smell great, but they don't absorb the water. These absorb the water. Just call the number on your screen. There are over 100 MyPillow products, or go to MyPillow.com, promo code ELDER. Finally, the Giza Dream Bedsheet. Let me turn it this way. Giza Dream Bedsheet. Giza is in Egypt where the finest cotton can be found. Mine, as you can see, is white because after all, I am the black face of white supremacy, but you're not. You may want a different color. They come in different colors. They come in different sizes because beds come in different sizes. I guess beds come in different colors too, but that's not the point. Call the number on your screen or go to MyPillow.com, promo code ELDER. Remember, over 100 products. MyPillow.com, promo code ELDER, or call the number on your screen. So, Alfredo, what should the president, in your view, have done?
I think in this particular case, they should have just focused on the Silicon Valley Bank. In reality, it was sold. I think that they should have said is that, we're going to take the receivership, we're going to sell the bank, we're going to look for a buyer, and that it was really an isolated incident. I think they almost triggered a run overall on all these regional banks on a national basis, the way they did that. So in reality, they did find a buyer for Silicon Valley Bank. It did cost FDIC about $20 billion, which will actually be refilled out of the FDIC fund. That will be covered out of the $100 billion that existed. So that will be covered in terms of fees across the banking community, which comes to my second concern.
So, Alfredo, had they done that, would those who had money above $250,000 gotten their money back?
I think at Silicon Valley Bank, they had to have done that. Unfortunately, it's not something that I like, Larry, but overall, I think just to basically, cancel out this fear contagion amongst consumers, it had to be done. But here's the big concern, Larry, is that
I'm sorry. Just make sure I understand. So, had they just said, look, Silicon Valley Bank mismanaged, poorly run, it's going to go into receivership, somebody's going to buy it, that's how we're going to handle this. Had that played out, would those who had more than $250,000 been able to get their money out if they wanted to?
It would have been a little bit of a pause, quite frankly, until they found a buyer. I was pretty certain, just based on its portfolio, that it was going to find a buyer, and it did. And basically, it took 2 weeks to find it. It did cost about $20 billion, like I said, to the FDIC, which has basically been covered by that fund, and it is going to be replaced. But Larry, my concern is that it's really, okay, so first of all, let me clarify. It's not a taxpayer bailout, and I want to make that very clear.
I was going to ask that next, yeah.
It is an industry bailout. But however, it is on the shoulders of consumers. It may not necessarily be on the shoulders of taxpayers, but on consumers of banking services. Because guess what? The higher fees that are going to have to basically be collected to pay back the $20 billion is going to be passed on to consumers through higher convenience fees, through higher banking fees. So it is in the end the consumers that will actually effectively bail out that bank. And that is what my concern is that that's the moral hazard that's being created, because by Janet Yellen saying we're actually going to cover our tier one banks, that would propose and potentially cause a systemic risk on our banking system, too large to fail again. That creates moral hazard, because effectively now, Larry, you have the small regional community banks that are going to be paying for the ills and the woes of these larger banks. So what is the incentive or the disincentive, I should say, for these larger banks to act stupidly like SVB did?
Would we be having this conversation, Alfredo, if if inflation had not hit 9%, had not now is at 6%? Would we be having this conversation if we were still talking about inflation at 1 or 2%?
Not at all, Larry. That is exactly the underlying root cause of what happened here is because of the reckless Democrat spending that's happened over the past couple of years in the Biden administration. Inflation, to your point, shot up. And the only choice that really the Fed had was to quell that the inflation is to raise interest rates pretty much at record rates, 4.5%, 4.75% actually over 1 year. That's what caught a lot of people off guard. But all that was caused because Biden had this reckless spending causing this record inflation. So to your point exactly, we wouldn't have been in that situation. Now, Larry, the big concern is that they're pretty much handcuffed. They did just take the quarter point. They might take another quarter point, but then they're done. And I don't think inflation is done at all. And inflation, unfortunately, is like a bad cold. It can come up and sneak back up on you and bite you in the butt. And I think that's what we're going to have here.
Well, that suggests to me, Alfredo, that the problem with Silicon Valley Bank and Signature Bank might very well be only the beginning.
Well, so what we'll have, I think, is more, because the outflows are already there from the regional and community banks. What I'm concerned about, though, is now as regional and community banks are pretty much are more and more limited on their ability to lend. Community banks, for example, represent about 60% of small business community loans and about 80% of their regional housing loans. And so I'm concerned that their ability to actually lend now is going to be curtailed, which makes it a lot harder for consumers overall to get credit for buying homes, for their credit cards, for auto loans. And that's where the biggest concern, I think, is going to be.
Last question. You mentioned when you first started out that in most banks, 90% of the depositors have money under the FDIC $250,000 guarantee. Right. In this case, it was a reverse. Why does somebody who has more than $250,000 in cash keep their money in a bank where only $250,000 of it is guaranteed?
That's a great question. That's a great question, Larry. And with Silicon Valley Bank, my understanding was, and this is where we really need to grill the regulators on this one, is that they basically had, in terms of their terms for loans, one of the requirements was that you keep all of your deposits with them. So that, in fact, I think is actually illegal, and I think that's going to be investigated, or at least I hope it is, because that kind of practice shouldn't be allowed, because effectively they handcuffed the people into that bank.
So bottom line, Alfredo Ortiz, should we be worried about our banking system right now?
I think the banking system is fairly sound right now. We are still going to see some ripples. But as you can tell, even with the worst, the issues with Credit Suisse on an international basis, that found a buyer local here, Regions Bank, which I think had an issue. It found ways of recapitalizing. And so from that perspective, I think our banking system is sound. But again, Larry, what I'm concerned about is we're seeing this outflow from regional and community banks. And remember that under Dodd-Frank, that horrible Dodd-Frank regulation, our small community banks, 2,000 went out of business. And I'm just concerned that we're going to see more and more regional banks go out of business. And eventually, Larry, we're going to have a nationalized banking system with 5 or 6 banks. And yet again, another part of our industry is just going to be controlled by big government.
Alfredo Ortiz, President and CEO, Job Creators Network. Alfredo, as always, thank you very much for coming on. God bless.
Thank you, Larry.
Now, I know you love the show, so hit that like button, hit that subscribe button, and then scroll down to the bottom and get on our mailing list. That way you'll be able to get all of our videos, because every now and then, from time to time, for reasons that confound us, YouTube has a problem with our videos. To make sure you get them all, get on our mailing list. Also, see that little donate button, hit that, throw a little something in the tip jar. Make sure we continue giving you hard-hitting, candid programming. Finally, Larry with Epoch, E-P-O-C-H, Larry with Epoch.com. I am Larry Elder. This has been the Larry Elder Show for Epoch Times. And I repeat, we've got a country to save. I'll see you next time.